Coming up on Business Incorporated today, Nigeria's inflation drops 7.33% year-on-year in February. The IMF approves $50 million to address the continuing impact of COVID-19 in Sierra Leone. And South Africa's Automobile Association warns of extremely high fuel price hikes at month end. Hello, welcome to the program. I'm Ladi Williams. We begin the show with latest data from the National Bureau of Statistics showing that Nigeria's inflation rate rose to 17.33% year-on-year in February from 16.47% recorded in January. On a month-to-month basis, the headline index increased to 1.54% in February from January's 1.49%. According to the report, food inflation was higher at 21.79% in the month under review compared to January's 20.57%, while core inflation increased to 12.38% from 11.85%. The urban inflation rate increased to 17.92% year-on-year in February 2021 from 17.03% recorded in January 2021, while the rural inflation rate increased by 16.77% from 15.92% in January 2021. Kogi, Bauchi, and Ebonyi states recorded the highest inflation growth, while Kwara, Enugu, and Cross River saw the slowest rise in inflation for the period under review. And looking at the markets now, the NSE in Nigeria ignored those negative inflation numbers, reversing the negative trend and was up 0.73% at intraday, largely driven by market heavyweight Dangote Cement. On the flip side, South Africa's GSE shaved off 0.69%, while the EGX 30 declined 0.61%. The market in Kenya ended Monday's session positive. There was a different picture in the Middle East where markets were all in the green at intraday. In the UAE, Abu Dhabi's index posted the strongest gain of 0.72%, while Dubai's index was marginally higher by 0.09%. Elsewhere in the region, the Qatari index rose 0.52%, while Saudi Arabia's index added 0.27%. And European stocks rose this morning as market attention focuses on the global economic recovery and the latest meeting of the U.S. Federal Reserve. Conrad Buzen has more on this for us. Hello, Conrad. Good to have you.
Good afternoon, Ladi.
Good afternoon.
Thanks for having me back on Channels TV.
So, new record highs for the Dow Jones and the S&P 500 yesterday. In Germany, the stock index there is trading slightly below its recent record highs. What's driving all this?
What's driving this is, a lot of government spending and a few positive earnings reports. Joe Biden's $1.9 trillion COVID relief package is not the only piece of government spending that markets can be happy about. Also, the finance ministers of the Eurozone at a meeting made it pretty clear that spending against the pandemic remains the program and not paying back debt, at least not this year and not next year. This is what the Eurozone's finance minister said at their meeting. Earnings reports, a few positive ones came out, for example, from Volkswagen, Europe's largest automaker. 1 year into the pandemic, I have to say the car maker is in pretty good shape. At the beginning of the pandemic, in the second quarter of last year, Volkswagen, of course, saw a big slump in sales, and the overall sales numbers and profits for 2020 are also lower than in 2019. But there was a strong recovery towards the end of the year, a strong return in sales at the Volkswagen Group, which includes many different brands, 12 brands, including Skoda, Seat, Audi, also Porsche. So the numbers that Volkswagen came out are strong. The share price is up this Tuesday, and in anticipation of strong numbers, this share price has risen more than 20% already during the last 4 weeks alone.
So from cars to an industry that's been particularly hard hit by the pandemic is travel. Frankfurt Airport reports a huge annual loss in 2020, but its CEO speaks of a light at the end of the tunnel. Tell us more.
Yes, but I have to say it's a very, very long tunnel that Fraport is in. After having reported the first net loss in 20 years, the CEO of Fraport, the Frankfurt Airport operator, also said that this year's result will likely remain negative. So maybe next year Fraport will be able to make a profit again with its operations. The light at the end of the tunnel, of course, is that people want to travel again and that airlines are ready to ramp up their capacities. We've seen it with Mallorca, the Spanish island, where very recently Germany lifted travel restrictions to and from Mallorca. Immediately the bookings went up, and immediately a couple of airlines increased the number of flights to and from Mallorca. Of course, the rollout of the vaccination programs helps the outlook, greater availability of testing options. That's very important for the airport operator. It says it's well positioned to fully benefit from an air travel relaunch. Long-term growth perspectives remain intact.
Vaccines. Now, more countries have stopped the vaccination with the AstraZeneca's vaccine. Germany, Sweden, France. The share price of the company is unimpressed by all this. Do you have more details on this?
Yes, obviously many investors are hopeful that AstraZeneca's or the stopping of the vaccination with AstraZeneca's vaccine will be short-lived. That is an opinion backed by the chief of the European Medicines Agency, EMA, which said that the benefits of this vaccine outweigh any risk. What's more, we have to say that even before, the vaccine never did much to push the share price of AstraZeneca up. That was very unlike the share prices of BioNTech, of Moderna, the other companies that were the first movers with their vaccinations, and their share prices had profited quite considerably. AstraZeneca's not so much. It looks like with every new vaccine coming on the market, investors were less willing to get excited about this. One last reason maybe in recent weeks, investors have shifted from more defensive sectors into cyclical sectors. So healthcare in general is a little bit less interesting for investors. And that might explain also why we haven't seen strong reactions of the share price of AstraZeneca due to those stoppings of the vaccination with this vaccine.
Okay, I guess we'll keep tracking to see how that goes. Anyway, Conrad, thank you so much for your time.
You're welcome.
And now to Asia. Asia-Pacific markets mostly edged higher today following a relatively subdued start to the global trading week as investors look ahead to the Fed meeting stateside. Australian shares rose as the benchmark ASX 200 gained 0.8% to 6,827 after finishing near flat in the previous session. The Nikkei 225 in Japan advanced 0.52% to 29,921 index points, while the Topix index gained 0.65% to 1,981. In South Korea, the Kospi added 0.7% to 3,067, while Hong Kong's Hang Seng index rose 0.6% in late afternoon trade. Chinese mainland shares reversed earlier losses to close higher. The Shanghai Composite added 0.78% to 3,446, and the Shenzhen component advanced 0.91% to 13,642 index points. And the FTSE 100 is up today. Let's talk to Juliana now for updates from London. Hello, Juliana. Great to have you.
Hi, Laddie.
Yeah, so AstraZeneca led the FTSE 100 higher, despite most countries looking at halting the use of the AstraZeneca vaccine. Where lies the optimism, and what's the sentiment at intraday?
Yeah, it's not been a great couple of days for the AstraZeneca Oxford University vaccine. 11 countries now, predominantly across Europe, have halted their rollout due to what they're calling severe side effects, including bloodletting and blood clotting. We are expecting the World Health Organization to deliver a report shortly after medical officials within that group start meeting. According to AstraZeneca, there is no cause for alarm. What they are reporting is that of the 17 million vaccines that have been administered, there are only 40 cases of blood clotting. Is this a overreaction? Potentially. Investors believe so, which is why they are one of the biggest risers on the index at intraday. The FTSE started off in positive territory, still in cruise control at intraday. The all-share is up 0.59%. The FTSE 100 is up by 0.52%, and the FTSE 250 is up by 0.87%. In the currencies market, the British pound not having a great day, down against the US dollar by 0.45%. Also down against the euro by 0.59% and down against the Japanese yen by 0.44% at intraday.
I guess having side effects is normal with vaccines. Well, despite posting its first annual loss as a listed company, Greggs has lifted its target for UK stores, anticipating that the pandemic will create new opportunities on the high street. How are analysts seeing this?
Well, Greggs, very, very, very popular bakery here in the UK. They have, as you said, posted their first annual loss since trading on the London Stock Exchange 36 years ago. They posted losses of £13 million in 2020. That compares to profits of £118 million in the period before that. Of course, this is all down to the pandemic. Back in November, they also announced that they would be getting rid of 800 jobs. One good thing about Greggs is that in the third national lockdown, which we're in right now, stores have been open, but they have seen footfall significantly fall because so many of the other non-essential retailers are closed at this time. One of the differences between Greggs and some of their other, if you can call them, luxury competitors of Pret-a-Manger, Costa, is that they're a little bit more budget. So they aren't necessarily in some of the high street areas where our offices, for example, they are in much more local regions. So they have shown that if you can access one of their stores via a car, then that store is doing particularly well. So they have announced, with the losses that they posted earlier today, that they will be opening a further 100 stores, and they will be in regions where cars can gain access to. Just like every other store, they've also seen their digital transition surge during the lockdown, so you can do click and collect orders. They're also delivering to some offices that have been able to stay open. So even though they have suffered this historic loss, investors were still happy, which is why they were trading up 5.2% at early trading.
Yeah, interesting. Well, the FCA has begun criminal proceedings against the taxpayer-owned lender NatWest for allegedly failing to prevent money laundering. What are you hearing about this?
Yeah, pretty serious story. This is the first time since these new money laundering measures were put in place by the city watchdog in 2007 that a bank has actually been charged to court. NatWest will appear at Westminster Magistrates next month, and this is to do with a single unnamed UK customer, and it's alleged that between November 2011 and October 2016, up to £365 million was deposited into this account. 264 million was paid in cash. The FCA, the Financial Conduct Authority, are alleging that this was money laundering, and they're not happy that NatWest wasn't able to pick this up, which is why they have been charged to court. This is the first time in the FCA's history that they've done anything like this. NatWest was actually trending on Twitter earlier today because of these allegations. As soon as this was announced, their shares dipped 2%, and they have released a statement saying that they're, of course, against money laundering and that they are going to fight this with nail and tooth, and they will be appearing in Westminster's Magistrates Court next week. So I'll keep you updated on that story, Laddie.
All right, we'll keep tracking that. All right, Juliana, thank you for the update, and do enjoy the rest of your day.
Thanks.
And U.S. stock index futures traded mixed earlier Tuesday after the Dow and S&P closed at record highs amid optimism over the economy reopening. Futures contracts tied to the Dow Jones Industrial Average implied an opening loss of about 40 points. S&P 500 futures traded near flat, while NASDAQ 100 traded slightly higher. During regular trading hours on Monday, the Dow jumped 174 points, notching its 21st record intraday high of the year and 14th record closing high of 2021. The S&P 500, meanwhile, gained 0.64% for its fifth straight positive session. Benchmark index hit its 16th intraday high of the year and the 13th record closing high. And the domestic commodities market is next. When we return from break, do stay with us. Welcome back. The global commodity cycle seemed to coincide with the growth boom-bust cycles. There are fears that commodity prices are again going ahead of themselves and could be fueling the much-dreaded inflation bug, which will lead to a premature increase in global interest rates in 2022. What could be driving this rise, and how would that affect demand? Favor Agunuraye, a research analyst at financial derivatives company, joins us now to talk more about this. Hello, Favor. Great to have you.
For having me.
So what are the underlying reasons behind the hike in global commodity prices? And do you think the surge is reflecting a super cycle?
What we are seeing now is natural. So a crash in the economy led to a decrease in commodity prices. And also now that we are seeing the economy recovering, we are seeing an increase in commodity prices. And we also, if we also consider the fact that a threat in rising inflation is making investors buy commodities in order to hedge against inflation, and also weakening dollar, making commodities more cheaper in other currencies. So all these factors put together are making commodity prices increase. And it could, in fact, it could indicate a super cycle, because just like what happened in the early 2000s when metal prices were increasing due to China's rapid industrialization, and presently we are seeing a similar trend in China where their industrial sector is booming, and we also see the world transitioning to renewable energy. So we expect resources like copper, lithium to also increase. So all these factors are signaling a possibility of a super cycle.
All right. So global consumer demand has been sluggish in 2020. And after an initial slump in commodity prices, we've seen an unexpected spike. With the ease of lockdowns and gradual return to normalcy, it is expected that there will be a recovery in activity levels, which will boost consumer demand. How will this impact commodity prices globally and in Nigeria?
With the increasing demand, we expect commodity prices to keep rising. But a critical factor would be supply. So that would mean that is the recovery in activity levels, are they encouraging supply? So if they are encouraging supplies, we will be expecting commodity prices to stabilize globally. But for Nigeria, it's more of a case of exports and imports. So if there's an increase in the prices of the commodities we import, that means that the import bill in Nigeria will increase. And also, if there's an increase in the prices of the exports of the commodities we export, that means that there'll be an increase in the export revenue. So a win-win situation for Nigeria would be that the export should exceed import, so that this revenue can be used to stimulate the economy. It can be used to purchase more COVID vaccines, and it can also be used as investment in capital projects, which can most likely address the food supply shortages that we are facing right now.
All right, so inflation rate has been trending all day. In Nigeria, food inflation rose to about 21.79% in February 2021, fueled by supply shortages, exchange rate pass-through, and an increase in the price of petroleum products. What do you think will happen to the domestic commodity prices ahead of the Easter holiday, and will inflationary pressures subside anytime soon?
Well, for festive periods, typically there's usually an increase in demand, and that would lead to an increase in commodity prices. But it's not the case right now. Just like what happened during Christmas, we see that the consumer's disposable income is low. So that means that people there won't be an increase in the demand. There won't be an increase in demand of commodities, which will now further drive prices. So, but that may not be the case because people want to enjoy themselves. So we could still see domestic commodity prices increasing. And in the near term, we don't expect inflation pressures to decline because of the food supply shortages, which are fueled by insecurity. They are fueled by electricity tariffs. They are fueled by the increase in fuel. And also now we are seeing new imposition of taxes on non-alcoholic beverages. So at the end of the day, we see all these factors being reflected in commodity prices, and we are not seeing that nothing has been done to address them. So we don't expect inflation pressures to decline anytime soon.
Anyway, we'll keep tracking the numbers and these indicators. Anyway, Favor, thank you so much for your time, and do enjoy the rest of your day.
Thank you very much.
So the International Monetary Fund has approved the disbursement of $50.37 million under the Rapid Credit Facility to Sierra Leone to help meet the urgent balance of payments and fiscal needs stemming from the deep and persistent impact of the pandemic. According to the IMF, Sierra Leone is grappling with serious and persistent effects of the COVID-19 pandemic. And while the immediate health risks appear contained, 2021 will be another challenging year. The fund says the economic and social impact is likely to be protracted, exacerbating long-standing development challenges and the strained financing situation. Sierra Leone's large development needs and tight financing situation will require concessional support, ideally grants from the international community in the coming years. And South Africa's Automobile Association is warning citizens to brace up for extremely high fuel prices at the end of March. The association explains that the rise in international petrol prices are being worsened by a dipping exchange rate, adding that fuel levy increases will contribute to expected high increases in fuel prices. According to AA, the expected rise does not include the 26 cents a litre increase to the General Fuel and Road Accident Fund levies announced by the Minister of Finance. The AA expects fuel prices to rise by 90 cents a litre. Diesel is seen increasing 66 cents, and illuminating paraffin is likely to rise by 62 cents. And that's it on Business Incorporated. Thank you for watching. I'm Ladi Williams. Bye for now.